average change clause is kicking in and said, I'm going to borrow everything I can. And that creates a demand for funds and interest rates go up. And then the recession hits and the bankers go, what's going on? Credit losses start going up. And then they just turn off the spigots and they raise standards. They stop doing loans. And then interest rates will start to come down. But interest rates peak after the recession has already begun. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. What I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened. They're going to keep going for the reasons I explained. That means they're going to make it worse. They're going to make the recession even worse. And we've seen this movie before. This is exactly what happened in 2018. I mean, I don't know. Attention spans seem to be short these days, but it wasn't that long ago. Go back and look at a chart, any stock index chart from October 1st, 2018 to December 24th, 2018. The stock market dropped 20%. I mean, it's like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%, culminating in the Christmas Eve massacre, December 24th, 2018, when it dropped, I think NASDAQ dropped like 3% in one day. Now, here's the point. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre. And after most of the 20% collapse had already happened, they tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. They don't care that much about the stock market level. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008, I mean, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly, but not just because they're going down.
Jim Rickards said that the Federal Reserve will only care enough if it's a disorderly collapse, meaning if the markets, either stocks or bonds, are going down like 30% in just 2 weeks. If it's just a little plunge in a day like a 5% drop in Amazon stocks, then the Fed won't care about it. But what the Fed and everybody is missing is the state of the economy itself. The unemployment rate is at its worst now, and massive layoffs in the tech industry are in the news everywhere. Because of what, you might ask? Yes, you are correct, it's because of the high interest rates. The companies need to pay more for the interest on their debt, so they have to reduce their headcount. At the same time, their revenue decreased because consumers unsubscribed from their services because of the rising prices everywhere, whether it's groceries, gas, or even food. So yeah, everything will go south, I guess.
Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. We know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because they runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation, or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61%, 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And has come down ever since, and it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. The reason it got, first of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. Yeah, there's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. There's a big untapped labor pool. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. And that's a depression level of unemployment. People say America has never defaulted on its debt. Well, first of all, that's not true. It's not a true statement. But the easiest, quietest, stealthiest way to default is inflation. It's like, hey, here's your $1 billion back. Good luck buying a loaf of bread because I've destroyed the value of the dollar. And so now 3%, we'll do it in, do the math, we'll do that in about 22 years. At 10%, you cut the value of the dollar in half in 7 years. By the way, that is what happened between 1977 and 1981. In that 5-year period, the dollar lost over 50% of its purchasing power.
According to Jim Rickards, hyperinflation is coming to America, and the raising of interest rates won't be able to help fight inflation. In fact, it will make inflation even worse. Inflation will impact stock market as Jim Rickards think it will brings the economy into recession, and unemployment will go up to 4 or maybe even 5%. But all Jerome Powell can say is, too bad, that's painful and we have to get there, but we're gonna pay higher prices if we don't. And then there's the myth of 2% inflation. The Federal Reserve have something called inflation targeting, where if they fail to have at least 2% inflation per year, then it means the economy is going into deflation, or to put it simply, the economy is slowing down and therefore unemployment is going to go up and the economy will go into recession. In order to prevent that from happening, the Federal Reserve have to target the inflation to at least 2% per year in order to bring price stability to the market and to keep the economic wheel running smooth. At least that's the theory, but to Jim Rickards it doesn't make any sense. The Fed have raised interest rates way too high, but the inflation is not going down yet. In fact, inflation goes way up even higher than before. People said between 1913 and 2023, the dollar has lost 95% of its value, but we don't need to wait for another 110 years. Jim Rickards explains that in the 1980s, the dollar loses half of its value in just 5 years. Will it do that again? Will the economy goes into recession? Let's find out.
A lot of people like to bang the table and say, since the creation of the Fed in 1913, the dollar has lost 95% of its purchasing power. Well, that's a true statement, but you don't need 110 years. We lost 50% in 5 years between 1977 and 1982. So inflation is insidious. It is a tax. It is a form of theft. But like the kid with the mother's wallet, if you keep the theft in small little bites, but do it long enough, you can get the whole thing and no one will notice. So they say we want 2% because we want to be able to cut if we have to. But the real reason is we want to basically erode the value of the debt and erode the purchasing power of the dollar in ways that you don't notice. And they can be very patient. That's how they do it. But to your point, Addison, well, hasn't the Fed been raising interest rates? Yes, but real rates are still negative. So if inflation's 9 and the Fed's at 2, the real rate is -7. That's a really, really low interest rate. And if you say, okay, inflation's come down to 6 and the Fed's up to 4, about 4.5 right now. So the real rate is now -1.5 in my example. Well, that's a lot less than 7, but still a negative real rate. We are not in the world of positive real rates. So then the question is, okay, how is the Fed doing at getting inflation to the target, the 2% we talked about? We explained why that's their number. And this says a lot about what's going on in the stock market right now, because you go all the way back to August 26, 2022. That was Jay Powell's Jackson Hole speech. And he said, inflation's, he didn't use the word out of control, but he said, inflation's way too high. We're going to bring it down to our 2% target. We know unemployment's going to go up. We know he will probably have recession. He did not use the R word. He didn't say recession, but he said, growth will suffer, unemployment will go up. That's just a fancy way of saying there's going to be a recession. And we're not going to stop until we get there. And so in other words, too bad, unemployment's going to go up to some number, I don't know what, 4 or 5%, which is pretty high. It's right now it's 3.4, I believe, the lowest since 1969. So unemployment's going to go up. The economy's going to go into recession, but too bad. That's the price we all have to pay to get inflation down under control. And the way to 2%, in other words, and the way Jay Powell rationalizes this, he said, yeah, that's painful, and we're going to pay a high price to get there, but we're going to pay a higher price if we don't. If we don't get to 2% and we let this thing spiral out of control and we even stay at 4 or 5% for a prolonged period of time, that the economic damage from that in terms of lost investment, misallocation of capital, basically people losing money on their investments, is going to be much higher than maybe a short recession.
Here's the interesting part. Jerome Powell scares the market with 6 speeches. He said the same thing again and again. We need to get to 2% inflation, which means raising the interest rates even more, and therefore we're going to have a recession and unemployment is going to go up. With the Fed being hawkish, the market should go down. Instead, the market got rallied because they believe inflation is going to go down soon. Jim Rickards thinks the Fed is already reached at something called the terminal rate, a rate which inflation will go down on its own, so the Fed won't need to raise the interest rates any further. But the Fed keeps raising it and making the economy crash even further. So how is it going to end? When will the Fed needs to stop raising interest rates? Let's listen to what Jim Rickards have to say.
So he said that the market didn't believe him. The market rallied, went down a little bit right around that time, but then the market rallied in October. And he comes out at the end of September, gives another speech at an FOMC meeting, comes out November 2nd, gives another speech, comes out November 30th, gives a speech at the Brookings Institution, and then comes out in mid-December with another speech, and then again a couple of weeks ago on February 1st. So it's like 6 speeches in about 5 months. And he said the same thing every time. He said, we're getting to 2%. Believe me when I said we're going to have a recession. Unemployment's going to go up. Too bad. We have a lot of work to do. We're not done. The market has flipped on and off. Half the time the market doesn't believe me. Go, yeah, you say that. But in fact, inflation is coming down faster than you thought. You're probably, I should introduce a concept. I guess a lot of people have heard of it, but there's this new concept called the terminal rate. The Fed's trying to get to the terminal rate. And so what's the terminal rate? Well, no one actually knows what the number is. I don't know, but neither does Jay Powell. But it's a theory. And the theory is, okay, the terminal rate is a rate set by the Fed that's high enough to bring inflation down without further rate hikes. We get to a level, and that level is high enough that inflation will come down on its own just by waiting without raising the rate again. And the conundrum, I hate to use that word, but it is a conundrum. The conundrum the Fed faces right now is They have been raising rates and inflation has been coming down. Those two things are true. But is inflation coming down because they're raising rates? In which case, maybe you want to keep raising them. Or are you already at the terminal rate? It's coming down on its own. And now the danger is you're going to go too far. And that's the debate with Wall Street. And so Wall Street is sort of leaning to the view, now you're probably already at the terminal rate. Inflation's coming down. You need to back off. You need to stop and probably pivot. This was the famous word for the last 6 months. The pivot means you're actually going to have to cut rates because you have gone too far and you're going to cause a pretty bad recession. And so the expectation as recently as December was that the Fed would pivot around March or April. They would raise in February, maybe March, but pretty quickly after that, they would cut rates. And if the Fed's cutting rates, buy stocks. It's typical Wall Street analysis. It always ends with buy stocks, particularly tech stocks.
So, with the current high interest rates environment and reckless government spending, what should we do to protect our money from inflation? Should we buy stocks? And what stocks should we buy? The Fed said it will raise the interest rates even further, but the market thinks the opposite will happen. So who's right and wrong here? Let's hear what Jim Rickards think. Spoiler alert. This is not investment advice.
But the Fed has been saying the opposite. So there's been this battle where Powell goes 1, 2, 3, 4, 5, 6 speeches, says the same thing. We're not stopping. And Wall Street says, oh, yes, you are. So buy stocks. Well, who's right? Well, there's an old saying on Wall Street, don't fight the Fed. I don't think of it as who's right or wrong. You could have an opinion. The way I think of it is I just want to know what you're going to do. Because if I know what you're going to do, then you can trade accordingly. You can plan for that and you can prepare for it. And what they're going to do is they're going to keep raising rates. Even if they're at the terminal rate already, I think they might be. Even if they are, they don't think so. Their opinion counts for a lot more than mine. And they're going to keep going. But by the time inflation comes down enough to say, yeah, okay, we're at the terminal rate, nice job, it'll be too late. They will have gone too far because the Fed's always the last to know. The supply chain was breaking down before COVID. Now, of course, COVID made it worse, yes. And the war in Ukraine made it worse yet, yes. But this really started with Trump's trade war in 2018. So that, like I said, there's a thread that runs through all these things. So not to throw out my hands, I'm not going to do that. But when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, Biden, they're all a big deal. If in terms of tragedy, probably the war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data, I never make statements like that, Brian, without supporting it. We know that the standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, and based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. There's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on the back of a recession.
Alone. I mean that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me. And I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20-30%?
Yes. And again, you have to remind people. 1929, the stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. That was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down the S&P down over 20%. We're in bear market territory. But that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, new car, whatever, you say, I better buy it now because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say we're putting up inflation numbers today that are the highest in 40 years. That is correct. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. That was when Volcker finally got it under control. But you go back to 70, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. So the question is, is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years, or is it different than that? But keep that in mind, because the situation we're in today is very different from the 1970s, and I'll explain why. But well, let's explain why right now, because in the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to $6. Okay, but percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was, the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor, and of course they're related. It's like here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, etc. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, "Hey, better spend the money fast because it's losing value." Why are those residential real estate prices going up? And the same thing's happening in the United States. The answer is that there is an exodus, and I don't think that's too strong a word, out of the cities. People are put off by, cities have always been a trade-off. Cities are, okay, you have a lot of noise and some dirt and some hassles and maybe a slightly higher crime rate. But on the other hand, you have art and culture and museums and shows and restaurants and bars. And so you make the trade-off. You say, I'll accept these annoyances in exchange for all this, culture and buzz. And cities attract, the brightest people. So whether it's, bankers or lawyers or doctors or artists, playwrights, actors, whatever, it's just, there's a lot of buzz. That's why people go to cities. With these lockdowns, we've amplified all the negatives and taken away all the positives. We've shut the museums, the restaurants, the bars, the plays, the office buildings, things that attracted people. But meanwhile, again, probably not as bad in Australia as it is here, but crime is on the rise. Murder rate in New York has doubled. Suicide rates across the country have tripled. And that's New York. The suicide rate's national. There are all these dysfunctions, and a lot of them, and of course, when you have highly concentrated populations, which you do in cities, a lot of that's where. So what people are doing, I say people, it's the people who can afford it. They're getting out of the cities, and they're going to nearby suburbs or even further out, what we call exurbs, which are, the next ring beyond the suburbs. And so there is that demand for housing. I'd be willing to bet money that the place you're describing is a pretty attractive neighborhood. So they're booming, and the same thing's true in the United States. But what's the other side of that? We're depopulating our cities. Cities are the greatest wealth generating phenomena in the history of civilization. That's what civilization means. It means cities. And so if we're depopulating and draining our wealth creating engine, what does that do to the economy long run? So as an individual choice, it makes sense and I understand it. But the macro effect is we're depopulating these wealth generating places. I mean, just take any downtown area. It could be Melbourne or Adelaide or Sydney or New York for that matter. If there's an attractive downtown office building, let's say you're a large company, insurance company, whatever, and you used to have 10 floors as your corporate headquarters. Well, now everyone's been working from home for almost a year. That's nothing that anyone would have recommended, a year ago. But we were forced to do it, and guess what? It works. Employers and employees are finding that, hey, it works. You can communicate and get stuff done, and maybe there's some attractions to it. So this work from home thing is here to stay. What companies will do, they'll say, well, instead of 10 floors, I only need 2 floors, and I'll have attractive offices, but you'll reserve them. You'll call up and say, hey, I need an office 2 days next week to meet some clients. Done. They'll build locker rooms. They won't be like high school locker rooms. They'll be very attractive. You'll keep your laptop and your sweater and your scarf or whatever in your locker. You'll show up, take your stuff out of your locker. Some receptionist will tell you which office is yours for those 2 days. Set yourself up, meet your clients, go home and work from home. What does that mean? If you cut commercial real estate capacity or utilization by 80%, we'll start with the cleaning crew and the reception, but what about the food trucks, the restaurants, the shopping, the public transportation, drinks after work, on and on and on, all the things that are ancillary to that downtown office location. You cut that by 50 to 80%. What is that doing to your economy? So these are examples. And by the way, this will take a year to play out. This is not an overnight thing. So the tenants are not paying rent. If they are, they've called up and negotiated a 50% increase. I have some involvement in commercial real estate, and I see this in real time. So rents are down by perhaps half or all the way to zero if they're not paying. And everyone says, well, landlords are rich. No, they're not. The landlords take the rents, but they have mortgages. So if the tenants aren't paying the landlords can't pay the mortgagee, and that falls on the banks, right? Except the banks are clever. They've securitized it and sold it probably to you and me, right? We have our 401ks like a superannuation fund, but you look in the fund and do you have some commercial real estate REIT or something that Morgan Stanley sold you? Well, maybe you do. And what's inside? No one knows, but take a look. But that ripple effect I just described can take a year to play out. So we haven't seen the end of this. So the bottom line on all this is that interest rates are going up in anticipation of inflation based on handouts. The reality is the handouts are not being spent, they're being saved, which does nothing for inflation. And it's also not sustainable, which is what are you going to do? Hand out a $2 trillion deficit spending package every 6 months? Because that's kind of what we've been doing since last summer. And they keep saying, well, this is the last one. It'll be sustainable. It's not sustainable. It's a handout and people need the money. But if they put it in the bank, which they're doing, this is a classic liquidity trap. So what's going to happen? Yeah. But meanwhile, the interest rates are going up, perhaps for the wrong reason, but they're going up. That's going to slow the economy further. We're already seeing mortgage applications dry up. We're seeing the housing bubble, not bubble, but pretty steep increase in residential housing starting to level up. So by, hard to say, but I would say by March or April, this whole thing is going to go in reverse. Everything we just talked about is going to go in reverse. The economy is not going to have the traction. Unemployment is going to remain high. Velocity is going to continue to drop. There's not going to be any inflation. Those interest rates are headwind. They're going to drop and the price of gold is going to shoot up. So my advice to potential gold investors is it's on sale. Go get some right now. It's always better to buy low and sell high. And but I would expect the price to be much higher by mid-year.
I know that you've said this before, or I'm pretty sure you've said this before, that to stimulate an economy, you need to reduce interest rates by somewhere around 3-4% to have an effect. When interest rates are currently at zero, how can you do that? Where do you go from zero?
Well, a couple of things. The short answer is you can't. You in theory, you can go to negative rates, but negative rates don't work. We have experience from the ECB, Sweden, Japan, Switzerland, and elsewhere that negative rates don't work. They're negative rates, but they don't. It's not more of the same. Cutting rates from 3% to zero has a beneficial effect, but cutting them from 0 to -1. Now you're through the looking glass. You don't get any more pop. You don't get any more bang for the buck. And there are reasons for that, which are as a central bank, what signal are you sending? Well, see, the idea of negative rates is you're going to spend the money. Because if I'm going to take it away, you put money in the bank, even at 0, you put money in the bank, you go away for a year, come back, the same amount of money should be there. That's a zero interest rate. But a negative interest rate, negative 1%, you put $100,000 in the bank, you go away for a year, you come back, you only have $99,000 because I took $1,000, that's 1% negative interest. So the idea is, if I'm going to take your money, you're going to spend it fast because you don't want me to take your money. And that's going to have the stimulative effect that we talked about. That's not actually what happens. What happens, two things. Number one, people have lifetime goals. Their retirement, their healthcare, their parents' healthcare, their children's education, buying a house. There's some large lifetime goal you have, and that's why you save money in the first place. If I'm taking your money away, you're going to save more, not less. You still want to achieve that goal. I've made it more difficult, but you're actually going to save more. They want you to spend it, but now you're saving more. And the second thing is, what signal is a central bank sending when they have negative interest rates? They're saying that they're worried about deflation, not inflation, but deflation. Yeah. So if they're telling me, if central bank is telling me that deflation is a problem, I'm going to wait. And why should I buy anything right now? Wait till the price drops. And by the way, a negative interest rate, negative 1%, in my example, is a nominal phenomena. But in real terms, if you have deflation, my money is worth more. So even though my dollar amount may be less, my purchasing power went up because prices went down. And so that's why negative interest rates don't work, because A, you're sending a deflation signal, so people defer spending, and B, they have lifetime goals, so they actually save more. So negative rates don't work. So you're right, you're stuck at zero, there you are. Pardon me, you can do QE, you can do quantitative easing. And usually what happens is they hand the ball over, I don't know if it's a rugby match or whatever, but they hand the ball from monetary policy, which is now impotent, to fiscal policy, which is deficit spending. But there you have other kinds of headwinds having to do with very high debt levels. More to the point, in terms of what a central bank can actually do, they can't stimulate. They can print money, and governments can spend money and incur deficit spending. But again, none of it does any good if people don't actually spend it, and that's a psychological phenomenon. And the Fed or the Reserve Bank of Australia or any central bank can print money, no doubt about it, but they can't change people's psychology. We had an external shock, an exogenous shock in the form of the pandemic that caused people to stop spending, save more, or they were unemployed. Or if you're the unemployed individual, you're not taking your friends out for dinner these days. You're putting money in the bank. And even if you still have your job, you're going to save money because you're worried you might be next. You might be the next one to get laid off, or your company might shut down next week or next month. And so you're going to save more. It's what economists call precautionary savings, or, in plain English, saving for a rainy day. And that's what's going on. It's going on all over the world. Payday, whatever, they pay you, but they deduct the withholding tax at the source, and it's based on the rate. So maybe it's, 20%. So you make $1,000, they take out $200, and here's the $800 net to you. And then at the end of the year, they give you a statement, you file your tax return, and you claim the withholding, and you reconcile your taxes. But that's not true for independent contractors, doctors, lawyers, professionals, writers, anyone who you earn a living, you work, right? But you don't have any withholding tax. But you still have, the money still goes in your bank account. Well, now they can just impose the tax on your bank account. Say, well, hey, we see your inflows here. You make a nice living. We're going to take 20% of that. Again, we'll send you a tax receipt, and file your tax return and sort it out at the end of the year. That would come as a shock to a lot of doctors and lawyers. So negative interest rates and withholding taxes are two things that are hard to impose if in a world of cash and non-central bank digital currencies, but they're easy in a world of no cash and central bank digital currencies. Well, it gets worse. This is the culmination, just kind of cut to the chase. This is the culmination of the total surveillance state. We already have facial recognition software, very good. It's like your face is like a fingerprint. Everyone's a little different. You say, well, that's okay. I'm going to put a mask on because COVID, and sunglasses, and pull a hat down to my forehead. You'll never see my face. You know what? They have gait recognition software, GAIT, meaning how you walk. Everybody walks differently. It was that Monty Python thing, the mystery of silly walks. Well, silly or not, everybody walks differently. And so they can actually digitally identify you just by the way you walk. And so your mask isn't going to help you. And with GPS, I have a bunch of what are called Faraday sacks. They're, some of them are nice, I'm glad they're wallets, but they're basically lined with a certain metallic fibers that block radiation. So if you want to turn your cell phone off, put it in a Faraday sack, and by the way, do the same with your Easy Pass and any other things sending out, radiation, which are ubiquitous. Maybe they can't follow you around, but most people don't do that, and they do. And so with your iPhone, they know where you are at all times. You may be looking at a map trying to find a good restaurant, but they're tracking you. So they already do that. But now they take it a step further. So you're at the point of purchase, you're buying a book. Let's say it's a book that criticizes Kevin Rudd, for example. He's your leading panda hugger down in Australia, or in the United States, criticizes Joe Biden or something, or, Ultra MAGA hamburger, whatever it is. Well, Ultra MAGA, you're an extremist, you're a radical, you're part of the insurrection. So now we're going to freeze your account or deny the purchase or put you on a watch list, or we just appropriated money to hire 87,000 armed IRS, Internal Revenue Service agents. Maybe we'll assign one to you because you bought the wrong book. So now we're into thought control. We're into basically subduing your political enemies, because well, if you give money to a certain political candidate, again, perfectly legal stuff, buy a book, make a donation, that's legal. But they don't like who you're doing it with. And they meaning the government, they're watching. They know what you're reading and by inference, what you're thinking, who you're giving money to, what causes you support, et cetera, et cetera. And it doesn't take much these days to have some, kind of low IQ spokesperson at the White House label you as an extremist. So this is all government's ever wanted, was total control of the people. It makes Louis the 14th look like a very hands-off kind of guy.
But Jim, the government would never do these things. The tax office would never target a political group. They would never target a group of people because of donations to different causes. They would never target protesters in any way. They would never target someone who's doesn't want to get vaccinated in any way. None of these things would ever happen.
Well, I know you're being actually very serious, but I know that's more rhetorical. The fact is, not only will they happen, they have happened, they are happening. This is the world we live in. That's absolutely the case. And let me give some concrete examples, because I don't put stuff like that out there without backing up. So in 2010, the IRS targeted what we called in the United States the Tea Party movement. This was the first midterm of President Obama's first term in office. Historically, a time when the president's party loses a lot of seats. It's not even Democrats versus Republicans. It's just a consistent pattern of first term president, first midterm election, they lose seats. Obama lost almost a record number of seats, something like 63 or 64 seats versus an historical average closer to 30. Because of people were upset about Obamacare, they were upset about the tax increases, the bailouts coming out of the 2008 global financial crisis favored the rich, hurt the poor. There was just a lot of people were having second thoughts about voting for Obama in the first place. So we had this Tea Party movement, and they just kicked butt in the 2010 election. Well, so these were springing up everywhere. This was a genuine grassroots movement. There was no nationwide top-down organization. Communities were like, hey, let's start our own branch of the Tea Party, et cetera. And because they qualified as nonprofit organizations, there's some rules around that, but you have to apply to the IRS, our Internal Revenue Service, for a designation and a number proving that you're a nonprofit organization. Well, the person in charge of those was slow rolling all the applications. They weren't getting approved. They were entitled to it. That the IRS intervened to squash the formation of Tea Party movements from coast to coast for political reasons, plain and simple. Well, that was 12 years ago, and there was no central bank digital currency. Imagine how much more powerful that kind of corruption is today. The key to understanding that is to understand that it was never, it's a form of money, but it was never a monetary project. It was always a political project. And once you understand the political dynamics behind it, you can see that it's not going to break up. So getting back to the BRICS, what they need is to expand the membership. And by the way, that's exactly what they did on August 22nd. So I said August 22nd, the Leaders Summit in Johannesburg, South Africa, and President Xi, President Modi, Prime Minister Modi, President Ramaphosa, President Lula, Brazil were all there. Putin would have been there, but there was an arrest warrant for his arrest from the International Criminal Court. So Putin didn't go. He's like, it's a distraction. And I said this would be a landmark or turning point in the development of the BRICS currency. And unfortunately for me, I actually have to read this stuff. And there's a 24-page single-space final communique from the BRICS Johannesburg Summit. And I read the whole thing. It barely mentions the new currency, just in passing in one section, kind of oblique, but barely mentions the new currency. And everyone said, hey, Jim, you said this was going to be a landmark in the development of the new currency. What happened? Well, the answer is it was. They did the thing they needed to do. It wasn't issuing a currency that was going to fail if you only had 5 members. They expanded the membership. They're now the BRICS 11. They added Saudi Arabia, Iran, UAE, Egypt, and a couple other countries. So now they went from 5 to 11, but they've got a waiting list of like 20. Other countries waiting to apply: Algeria, Argentina, Malaysia, et cetera, et cetera. Now, who did they add? Well, when you put Russia, Saudi Arabia, UAE, and Iran, and Brazil in the same group, who needs OPEC?
Jim Rickards sheds light on a strategic shift in the global economic landscape, emphasizing the growing influence of BRICS nations. With Russia, the second-largest oil producer globally, now part of BRICS, the consortium's combined oil output surpasses that of OPEC. The prospect of an expanded BRICS currency gains significance, offering member countries the ability to conduct trade in their own currency. The example of Russia selling oil to India and receiving payment in the BRICS currency highlights the potential for diversified trade beyond conventional norms. And then Jim Rickards envisions a broader membership, possibly reaching around 20 nations, enhancing the viability of the new currency. This approach echoes statements from figures like Lavrov, who previously hinted at the currency's establishment, although not explicitly gold-backed in a traditional sense. Jim Rickards underscores the geopolitical implications of this economic realignment, as BRICS nations position themselves for increased autonomy and collaboration, challenging established economic norms.
You've got more oil output in those 5 countries than you do in OPEC, because Russia is not a member of OPEC, and it's this second largest oil producer in the world. So OPEC is now inside the BRICS, or the OPEC power to set oil prices is now inside the BRICS. But more importantly, now that you're up to 11, and again, they're on their way to 20, given another year or whatever. So now you launch your BRICS currency, and you're Russia, and you sell oil to India. Instead of getting paid in rupees, you get paid in the BRICS currency. The difference is, instead of having to buy, whatever, rice from India, you can go shopping. You can go to Brazil and buy Embraer aircraft. You can go to China and buy semiconductors. You can go to Iran and buy drones. You can go to Argentina and buy, they have a lot of natural resources, et cetera. So can everybody else. China gets paid in the BRICS currency. They can buy oil from Saudi Arabia, the oil from Russia, et cetera, or Embraer from Brazil. They're very good aircraft. So the point being, when you expand the membership, you make not just the likelihood, but the feasibility of the new currency much, much greater. And so give them one more round. They'll invite in another 6 or 7 members next year. They'll get up to around 20, close to 20, which is about how many members you have in the European Monetary Zone, and then launch the currency to great success. So that's how it's playing out. The gold link, and this is what Lavrov said about 6 months ago, he never said it would be gold backed in the sense that if you had some BRICS, you could march down to the People's Bank of China, the Central Bank of Russia, and say, give me the gold. He never said that. And, again,
Jim Rickards delves into the intricacies of a potential new global currency and its ties to gold, drawing inspiration from John Maynard Keynes's proposals in 1944. However, Jim emphasizes that while some critics may nitpick the distinction between being gold-backed and gold-linked, the crucial point is determining the value of the currency in relation to gold. Using the hypothetical term brick for the currency, the argument underscores the uniqueness of this system, where one unit equals a specific weight of gold. The key insight lies in the currency's fixed value in terms of gold, employing the transitive law. This approach essentially places the burden on the US dollar to reflect the fluctuations in the global gold market. The genius, as pointed out, is that the issuing nation's BRICS can navigate this new monetary landscape without direct involvement in gold transactions. The prospect of a currency's value being pegged to gold adds an intriguing layer to global economic dynamics, with potential long-term consequences for the US dollar.
Again, I don't want to mention names, but, the usual suspects get all spun up over this and they're on all these programs. He never said that. What he said was that it was not gold backed, but gold linked. And what he meant by that, and he was specific. He said, because you have to ask yourself, what's the value of a brick? One brick. I call it a brick. I don't know what they're going to call it. Maybe the bank were in honor of John Maynard Keynes. By the way, everything I'm talking about is what Keynes proposed that Britain was in 1944. It was all shut down by the United States, by Harry Dexter White, who was a Stalinist agent. But this is basically the return of the ghost of John Maynard Keynes, because what the Russians are doing is exactly what Keynes wanted to do. He wanted a world currency, not a US dollar. But what Lavrov said is that, okay, we're going to define the value of one, I'll call it a brick. One brick is going to equal a weight of gold. And he didn't say what the weight is. I say 1 brick equals 1 ounce. That's just for illustration purposes. It doesn't matter. You can call it a bancor, you can say it's a kilo. It doesn't matter. All of a sudden, you have a currency that is the value of which is determined not by reference to another currency, but by reference to gold. Now, you say, well, okay, but what does that mean out in the real world? Well, there's a dollar market in gold. The global market in gold is dollar denominated. You can buy in other currencies, in a store or something like that, but it's pretty much a dollar market. So now we're back to Aristotle, who created syllogisms and logic, father of logic, and the transitive law. So if 1 brick equals 1 ounce, again, just for illustration, and 1 ounce equals a certain number of dollars, today it's, 1950, up and down, whatever, then with the transitive law, you can say, well, 1 brick equals $1,900. But here's the key. It's not a fixed exchange rate. As the dollar price of gold fluctuates, the value of a brick as a weight of gold will not fluctuate. It's fixed as a weight of gold. But using the transitive law, the dollar value will fluctuate. But it means the US has to do all the dirty work. In other words, this is the genius of the Russians. They can just free ride on the dollar gold market. They don't have to intervene. They don't have to buy gold. They don't have to sell gold. They don't even have to have gold. You just say, this is what it's worth, and then let the dollar do all the dirty work. With one footnote, which is if you're the issuer of bricks or the holder of bricks and it's worth a weight of gold, what do you want to happen to the price of gold? Well, you want it to go to the moon because you're destroying the dollar through the transitive law and through the dollar-denominated gold market. That's for the long run. But the Fed has a hidden asset.
In a surprising revelation, Jim Rickards talks about the Federal Reserve's balance sheet. He unveiled a hidden asset, gold certificates dating back to 1934. These certificates were issued to compensate the Fed when the U.S. Treasury confiscated its gold, a move that is believed to have legal complexities under the Fifth Amendment of the U.S. Constitution. The certificates, valued at the fixed rate of $42.22 per ounce on the Fed's balance sheet, were originally meant to represent the historical cost of the confiscated gold. However, the intriguing twist emerges when considering the potential revaluation of these gold certificates to reflect the current market price of gold, which hovers around $1,850 per ounce. If the certificates were marked to market, it could reveal a hidden asset on the Fed's books worth approximately $350 billion. This unexpected revelation adds an interesting dimension to the ongoing debates about the Fed's solvency and financial stability. The implications of such a revaluation extend beyond the immediate financial adjustments. It could revive discussions about the gold standard, a monetary system where a country's currency is directly tied to a specific quantity of gold. This potential move could be seen as acknowledging the true value of gold and its role in backing the country's currency. Jim Rickards speculates on how the gold price might react to such a revaluation, positing it as a significant event that could attract attention and prompt a surge in interest and investment in gold. Furthermore, the potential move could be perceived as the Fed indirectly reverting to a gold standard, with Jim Rickards estimating that a conservative 40% backing of M1 money supply would necessitate a gold price of around $15,000 per ounce. In essence, the idea of marking the gold certificates to market on the Fed's balance sheet is presented as a complex and potentially transformative event that could have far-reaching consequences, sparking debates about the role of gold in the modern monetary system and the potential impact on the economy.
If you go again, to go to the balance sheet, go to the asset side, the first line item, there's something called gold certificate. And what is that? Well, in 1934, the U.S. Treasury confiscated the Fed's gold. They'd already taken the gold from the U.S. citizens by that point, but they wanted it all. And so they took the Fed's gold, but under the but again, bear in mind, the Fed's privately owned. So under the Fifth Amendment of the U.S. Constitution, it is illegal, it's unconstitutional to seize property without paying just compensation. You can do it, but you got to pay the person. And then people get into all kinds of arguments about what it's actually worth. So what just compensation did the Treasury give to the Fed when they took the Fed's gold in 1934? The answer is they gave them a gold certificate. It can be, you can calculate it. In other words, you can say, well, what is the amount of gold by weight, not by dollar value, but by weight, that is needed to back up that certificate given the historic cost? So the answer is about 8,000 tons. Guess how much gold the Treasury has? About 8,000 tons. I mean, one of the reasons I've hypothesized that the Treasury stopped selling gold in 1980, because they lost gold to trading partners between 1950 and 1970. They lost 11,000 tons. They went from 20 to 9, but they sold another 1,000 tons in the 1970s to suppress the price of gold, which failed because it always does. But by 1980, they had were down to 8,000 tons, and they stopped. Why did the U.S. stop selling gold? We've never sold any significant amount of gold since. The answer is, in my view, is that they can't go below that, because that's the amount of gold the Treasury needs to back up this gold certificate on the Fed's books. So, okay, just kind of put that to one side. That asset is valued on the Fed's balance sheet at $42.22 an ounce. Price of gold, look today, it was about $1,850 an ounce. Now, so, what's, as I say, sauce for the goose is sauce for the gander. If we're going to mark the mortgages to market in a world where interest rates have gone up and the mortgages have gone down, it's only fair to mark the gold to market. And if you mark that gold to market at $1,850 an ounce versus $42, voila, you would find that the Fed has another approximately $350 billion of hidden assets. So I think that takes care of the solvency problem. So before we beat up the Fed on mark to market on mortgages, that's fine, but have a look at the gold and realize that they have a hidden asset, a shadow asset on their books that's worth in the hundreds of billions of dollars.
What do you think it would do to the gold price if they did revalue mark to market their gold holdings? Do you think that would create a lot of attention for gold and people would pile in, or do you think it would just be an accounting change that no one really notices?
I think it would be a very big deal. But it begs the question, if you're going to revalue it, to what level do you revalue it? So everyone said, well, the market's 1850, that's about where it is today. It goes up and down, but revalue it at 1850. That could be highly deflationary. And the reason is, in effect, you're putting yourself on a gold standard. You don't have to. That's why they won't do it. They don't want to touch it. But if you did, you would be saying, hey, gold's really worth 1850 and we have this much gold, et cetera. But at that point, analysts would sort of turn and say, well, you're back to a kind of gold standard. What's the relationship between gold and money or currency or US dollars and others, the money supply? But what is the relationship between gold and money supply? What you would find is that at 1850, the gold relative to the money supply is about 2%, whereas historic gold standards were run with somewhere between 20 and 40%. Bank of England in the 19th century managed a successful gold standard between the Congress of Vienna and World War I with about 20% gold. In the US, through most of the 20th century, at least the first half, ran a gold standard with about 40% backing. It was actually the law. The law until the late 1960s, I think 1968, was that the Fed money supply, base money, could not be more than 2.5 times the value of gold. Originally at $20 an ounce, $20.67 an ounce, later $35 an ounce. But whatever that number was, times the amount of gold, that had to be 40% of the money supply, and the money supply could not be greater than that. And then they got rid of that in 1968 because of the war in Vietnam. But the point being, 20% has worked, 40% definitely works. The Austrians like to bang the table and insist on 100%, but maybe, but that's historically not been required. You just need enough gold to be able to give gold to people who want it when they want it. And if you're credible in that dimension, most people are content to hold the money. So as a hypothetical, you can say, well, okay, let's say we want a gold standard, and let's say that we want 40% backing of M1. M2 is a bigger number, or at least it can be. Let's just say, so 40% backing of M1, that's a conservative kind of gold standard, not extreme, but reasonable. What would given the amount of gold the United States has, what would the price of gold have to be in order to maintain that ratio? The answer is about $15,000 an ounce. And people say, Jim, you used to say $10,000 an ounce. Well, that's true because it was true at the time. But when you expand the money supply, the number goes up, right? Because the amount of gold is fixed. So it was 10,000 not that many years ago, and today it's 15,000. Well, if you say gold's worth 1,800, people are going to say, well, give me the gold. I'll take all the gold you got at that price. And then they're going to have to shut the gold window again, and that has its own problems. But in other words, it's not clear how it would work. I mean, there are a lot of ways it could work mechanically. It's not clear what the government would actually do. But my point is, if you try to mark gold to market on the Fed's balance sheet, you're opening Pandora's box. Because you would be getting a lot of people, bankers, analysts, Wall Streeters, investors, to sit up and take notice and say, well, hey, what is going on here? You're back in the gold business. Well, you got the price wrong because you can't back up your money supply at that level. And the truth is you can't.
I also believe, as I said now twice, that we are on a shift away from treasuries into precious metals as a store of value, which could be a massive injection into that market. And let's not forget that over the past 120 years, right? Anytime 100% of countries that cross over the 130% debt to GDP have defaulted on their debt. And it's usually due to massive inflation, hyperinflation, instead of outright default. But whether it be a inflationary default or an outright default, every single country over the last 120 years that has gotten to 130% of debt to GDP has never come back. That's where we are. The U.S. government really can't repay its debt, and default, in my mind, is inevitable. And as a result of that, holding U.S. treasuries would be as dumb as building a mud wall. So I think the alternative to the elite is gold, and it will soar. And I don't expect an explicit default unless, of course, Saudi Arabia and OPEC dump dollars as the store of value, or as the petrodollar, which I believe is highly likely, ultimately. And then you have a villain to point to for your default. It was OPEC and Xi Jinping and Putin. How could they do it to us? But I think if I were going to make a trend, the only trend I would add to Michael's statement, which I believe both. I think AI is certainly overvalued and could very well transition out of there as the economy starts. Money would transition as the economy begins to slow. But by the same token, I would say precious metals go higher. I agree. But I would also say that we will move into a period of time where treasuries are no longer the go-to store of value. Anyways, bottom line is that, yeah, I think that he's right. He's spot on. I think that one area is massively overvalued, one area is massively undervalued, and one area, the treasuries, is going through a once in a generation shift of recognition. And I think it's going to be a very bumpy ride. So when we talk about owning precious metals, Jesse, I don't tell people to do it to get wealthy. It is wealth. Wealth that has outlived every transition, 2 world wars, German hyperinflation, the Great Depression, every pandemic, and it will still be wealth when this situation ends too. And evidenced by the fact that the people who are writing the playbook the central banks, well, they're loading up on it as if it was really important. So it's the suppression of the Western paper markets that has enabled them to do this without people catching on, because the price hasn't exploded, and in particular in silver.
Could we get into an arms race type situation where central banks are all trying to accumulate as much gold as they can, and there might not be enough physical gold to fill their orders at some point?
I think that's why they've used the Western suppression to run cover for their accumulation, which I would argue has been going on at least since 2017 or 18, when you saw the repatriation by the central banks from the New York Fed and the Bank of England, starting with the Bundesbank. And in 2018, all of a sudden, those banks bought more gold that year than they did in the 60 years previously combined. That would be like the Dutch National Bank, the Bank of Hungary, Turkey, the Czech National Bank. All of these countries have been on a buying spree, many others on a buying spree, of course, China and India and all of those. But look, let's just, again, like I said earlier, from a historical point of view, using government treasuries and bonds as a savings vehicle is a relatively new concept in the historical context. And I think it's fading. And I think that already the elite have rediscovered gold is and has always been the premier store of value. And I think it's happening in a big way. And as you mentioned, last year, the central banks bought 37 million ounces of gold, a multi-decade record. Over the last 18 months, they bought more than in any time in history. And, so if you talk about this year, you're right. They bought 800 tons so far in the first 9 months of the year. That's up 14% year over year. Last year being the biggest year on record, and now it's up another 14%. And I think, in short, we're on the verge of this shift from in international finance, and gold is going to replace the treasuries, I think, as the premier store of value. And it is happening. And at the same time, these central banks not only have been voraciously accumulating it while using the suppression of the Western paper market to run cover, where you have 35 times leverage and you can short the market on paper and buy the physical without really the whole world jumping into it because of the price going to the moon and attracting attention. In fact, quite to the opposite. The counterintuitive price action and the suppression of the market has enabled these big players to front run what is ultimately going to happen. And I don't think we've begun to really see anything yet as far as that is concerned. These traders are always way ahead of the curve. And when it breaks when there just isn't any ability for the Western suppressed markets to suppress in a naked fashion. In other words, it will be far too dangerous to sell short. Let me say what I mean by naked. Right now in silver, as an example, there is 1,700% more paper contracts than there are bars backing those contracts. In other words, it's rehypothecated 17 times. And so if for every one real contract that could be delivered in physical form, 16 won't be, or 17 won't be. You get paper settled, it is rehypothecated. And that's why we're already beginning to see in China, as an example, the Shanghai Gold Exchange has gold price, last I looked, at about $100 higher than the LBMA or the COMEX price. I don't care what these economists tell you is the justification. In my mind, they are trying to arbitrage slowly whatever is not nailed down. And they've already done a good job at pulling stuff out of the COMEX, out of the LBMA. They're pulling the physical commodities, not just gold and silver. You're seeing the industrial metals too, aluminum and zinc and copper. They're all being accumulated by these nations, and they're using the suppression of the Western markets to do it. At the same time, they're selling treasuries. So if anyone wonders why the treasury market experienced its worst year ever and the yields keep rising and the back end of the curve keeps rising, because they're all dumping their long treasuries. And even at a loss, I think they would rather sell them and shift and transition to gold before things get really dirty. So yes, I think that what we will ultimately witness is a moment in time where the rehypothecated levered Western paper markets will enable the rest of the world to siphon everything out of the weak hands of the West, and it will all move eastward. And when all of the metal is there, or the majority of it, where the Western markets are rendered neutered or a scam because of their hypothecated model, then you will see other parts of the world establish a more reliable and credible benchmark, whether it be in Abu Dhabi or the Shanghai Gold Exchange or the Moscow Metals Exchange. It will be that portion of the world, those who have been accumulating it all, who produce it all, who understand what it really means. They're going to say, we don't want to buy from your Western system anymore, and we don't believe in your Western system anymore. And in fact, we are going to implement our own system. And, you know, you can see how banks will arbitrage for a few cents a share, millions and millions and millions of dollars. Well, how about $100 an ounce? How about putting silver at $50 and watch what happens to all the silver over here that immediately arbitrages over there in a one-time shot to make these bankers very wealthy. And now we have stripped clean all of the physical silver and gold that will be available that would have been available for the people in this country who will wake up last minute and say, whoa, geez, you know, I better get something. And it will define this market, the inability to source product on every level. And that's when the price goes parabolic.